Hello, good morning. In this session, we try to see how to minimize risk in trading stocks. Okay, so what is this risk? It means if you, for example, you buy 100 shares, of a stock that it is $10. Okay, $10. You spend $1,000. Okay, this is the money that you put into this stock. Okay, now the thing is that when you buy today and you wait for tomorrow or next week or the other week, this $10, this is the chart, $10, it can go up or down. Okay, it can go up or down. If it goes up, you make money. Okay, for example, $10, it becomes $12. You gain $2. Out of this 100 shares, you will get $200. Okay, because you buy 1,000 and it is 100 shares. So you gain $200. Now, suppose that it's going down. Now you, here, when it goes down, you should stop your loss. You shouldn't let the 10 goes to $5. Okay? Why you shouldn't let this go down? Because what is your intention? Is you are going long. You are going that the stock, you think that the stock is going up, and you are wrong. You are wrong. Okay? So you are not right. The stock is going down and down and down. This is the problem. If you don't put a stop loss here or here, for example, at 9.50 or 9 or 8, depends on what is your stop loss. What will happen? The price is going down, and when it goes down, it eats your money. This $1,000 minus, you don't know how much money the stock goes down. And you say to yourself, okay, the stock goes down, but it goes up again later. Now, how do you know that the stock goes up? Okay? So no one knows what will happen to this stock. Maybe from $10 you find it $1 or 50 cents in some days or some weeks. You don't know. So that's why, in order to be what we call safe and minimize risk, any trade you have risk. Okay? I repeat again. In any trade that you do, in any trade, you have first to think about risk. What does it mean risk? It means how much money you can lose if you are wrong. How much money you lose. You tell me, for example, I am buying this stock to make money, not to lose. Yes, you are right. But when you buy this stock and it goes down, you are wrong and the market is right. So since the market is right and you are wrong, you should leave this stock because you are going up. Okay? So if you understand this, this is the basics of trading stocks. And anything else, wherever you are, in trading stocks, options, futures, wherever you are, you should think about minimizing your risk. Okay? Because if you let the risk go down and down and down, and you lose more and more and more, for example, from 10, you go to $5, you lose 50% of your money. 50%. It means 1,000, it will be $500. And you lose all your capital. Okay? When you lose your capital and 500, it becomes 100. 100 becomes $10, and then you cannot trade. You cannot trade and you can't stay in trading. You will quit because you have no money, no capital. Okay? So minimizing risk in trading stocks is very, very important. The most important one, the most important thing to know is to use what we call a stop loss. Automatic, okay? For example, you buy at 10. When you just buy the stock, put a stop loss, for example, at 9. Now, if the stock goes up, you are happy, you are making money, it's very good for you, okay? Now, but suppose that the market is going against you and from 10 it goes to 9. Now, you get out here, you exit, you have a loss with $100. It's better than to stay and it goes to 8, 7, 6, 5. You don't know how much it goes. Okay, if you like the stock, for example, if you sell it at 9 and it goes at 7, but from 7 it goes like this to 10 here and it's going up, you can buy it here again, okay? Because you see that the stock is going up and maybe you can make a profit from this, okay? So this is the minimizing risk, but there is no safe trading. No safe trading. This is very important to understand if you want to become like a trader or professional trader. There is no safe. There is no, because the price, wherever you use as a strategy, or you use like averages, moving average. Okay, like this, cross, you buy, they cross, you sell, as you know, as all this stuff, the moving average or anything else. But there is no safe, because the market is made of traders. The market is made of traders and investors. I will give you an example of an investor who wants to sell off. Okay, an investor buys a stock, for example, at $10 and now it is 70. Okay, from $10 he stays, for example, 2 years. He doesn't care about this, about going down a little bit, going down like this. Okay, the stock is going like that. But right now, after 2 years, from 10 to 70, it's a big money. Okay, it's 700%. And he waited 2 years, this investor or this mutual fund. Now what does he do? He finds another opportunity with other stocks, $15. So he wants to take his money from this stock and goes to this stock. Okay? So what does he do? He sell off, and you will see like this. From 10 to 70, and then you find it here to $40. From 70 to 40. Now why it goes to 40 when one big investor sells? Because when he sells, other people who are here sell too, because they understand that the stock is going down too fast. And most of the time there is no problem with the company. The company is good and it's making money and the earnings are good. That's why people, they get confused between the company and the stock. I will do a video later about this. Okay? So for example, for you, you buy the stock at 65 and it goes, you are a trader, and it goes to 70. Okay? But if 70 goes down to 69, 68, you should sell, because if you don't sell, it goes here to 65, and then instead of having money and you get a profit, you will see that all your money that you profit, it goes down and you lose money. Okay? So you are not an investor, you are just a trader, so you take the money that you get and that's it. But those people here, the investors, mutual funds, they have too much money because they push the price, they buy more, they push the price, goes up. Now you can push the price of a stock because you have a little money. But these guys, big investors, Now, I will give you an example in order to understand this. For example, like Warren Buffett. Just an example. Warren Buffett chooses a company, but chooses the company and what he calls the value investing. People, they get confused and they will never know what does it mean, this value investing. Okay? Because Warren Buffett and all the other guys, they do the same. They do push the price by buying more shares. For example, it's $10. This guy like Warren Buffett, if you find a stock that is $10 a share, and the company is very good, it's not because it's very good that the stock goes up. Because Warren Buffett doesn't know the future. Okay? No one knows the future. But Warren Buffett knows one thing that the other people, they don't know. So what is this thing that Warren Buffett called the value investing? It is his way of pushing the price. This guy like Warren Buffett, he buys millions of shares a week or a month. Millions. Okay? Now when a stock is $10 and you buy millions of shares, the stock should go up by force. They force it to go. Okay? From 10 to 12 to 14. Now when the other investors, they see that the stock is going very quick and it's going up and up. For example, from 10 it goes to 14. Some other people will come. Okay? Traders, big investors, they come because they see the stock, but they don't know who is buying. For example, Warren Buffett is buying. But this guy, Warren Buffett, he's so intelligent to buy more and more. Okay? And he wants to buy a lot. He doesn't want to buy like 1,000 shares, 10,000, 20,000. This guy has billions of dollars. When he takes a stock, when he buys any stock, it should go up. It's must. Now, for example, he buys 10. It goes to 12. He buys more. He buys more. And the other people buy. He buys more. It means he push. When it goes like this, $10, it goes to 20. Some sell. But from here, from 20 to for example, 15. He will push to 25. He will buy all this and the people follow. From 25, some people sell, for example, to 23 and then to 30 to, for example, 27. And then it goes to 40. This is how do you see, and if you can take a lot of stocks, and if you see, for example, Warren Buffett stocks that he bought, you will see that it has this chart. Or you can see like chart like this, and you see, and when he sells, when he has a big profit, okay, this guy like Warren Buffett, when it from 10 it goes to 200, okay, it's not only him who buys, but other people follow. Now when it is $200, Warren Buffett say, okay, this is the jackpot. It's from 10 to 200. Now, 10 to 200 is too much money. Okay? It's too much money. He for example, from 10 to 100 is 1,000. He gets, for example, 2,000% of his money. That's why they say Warren Buffett, money, it goes so fast. That's why he became a billionaire. Okay? So when he buys, but this when he buys, he doesn't tell anyone that he buys. Okay? This is a secret. That's why trading is a secret. Now, and then from 200, he sells off He sells all his shares, millions of shares. For example, it goes to 170. Okay? Some people, they buy at 20, 50, 70, 100. Those people make money too. But the problem is that he is the one who have the jackpot. Okay? So forget about what you call value trading, and he knows, he doesn't know. What he knows is, he knows how to make the stock goes from 10 to $200. This is what he knows to do. Because his father was, Warren Buffett, his father was a broker, and Warren Buffett was a broker. He knows all the stuff going inside the brokerage firms, and how to buy, how to sell, how to push the price. Is very easy. Okay, for him it's very easy because all his life is in this business. That's why when he say, I buy a stock, I don't buy a stock, I buy a business. But it's not true, because a lot of stocks that he sold his business. Okay, and if he see that the business is going up and up, his $10 going to 100. Why he doesn't keep all his stocks he buy? He sells most of it, except for some stocks that they go so high because it is his company, like Hathaway company, insurance company. It is his company. That's why he doesn't sell his company. Okay, it is his company. He directs it. He has all the stuff. That's why minimizing risk is very, very important. Okay, when you see that the price go down, don't think that it stops and then it goes up. You don't know. But these people who are big investors or mutual funds, they know. Okay, this Warren Buffett example is just an example on how the price goes up and goes down, and you should be always alert. You should always be cautious that these people in the market, they have no mercy. They are professional, and they want to take your money. Your money you put, they short it, they take your money. Although the company has nothing to do with the stock. Okay? So, always remember that in order to minimize risk, you should use a stop loss. Okay? You buy here, you buy $10, for example, or 20 or 30. When it goes down, you should sell. You shouldn't wait until it goes from 9, 8, 7, 6, 5, 2, and you are holding your stock, and you will, and then you begin to ask yourself, the company is good, but why the stock is going down? Okay, it goes down because some people are selling. Okay, so this is in general about minimizing risk. And as I told you, there is no safe thing. There is no safe thing in trading. If you want something that it is safe or something, you go and buy, for example, bonds or CDs or other stuff that they give you interest. For example, they give you 2% or 3%. It means you are just having this money that you know, and so you are not trading anymore, so you are doing something else. Okay, if you have any question about this, please write back and comment. And if you have any question, please ask. Thank you very much for watching this video.